Ladies and gentlemen, good day and welcome to Radiant Cash Management Services Q4 FY2024 earnings conference call hosted by Antique Stock Broking. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand over the conference to Mr. Sarvesh Mutha from Antique Stock Broking. Thank you and over to you, Sarvesh.
Thank you, Ralph. We welcome you all to Q4 FY24 earnings call of Radiant Cash Management Services. We have with us today the entire management team. So, Colonel David Devasahayam, CMD, Mr. T.V. Venkatraman, CFO, Colonel Ben, COO, Mr. Alexander David, GM Operation, and Mr. Muthuraman, Director, Advisor Strategy and Investor Relations. Without further delay, let me hand over the call to David sir for his opening remarks, post which you can start the Q&A. Over to you, sir.
Thank you very much, Sarvesh. Good morning, ladies and gentlemen. Thank you for joining us today for Radiant's investor call. The year 2023-24 has been a year of investment and consolidation for Radiant. A demanding and challenging call we had to take in the long-term interest of your company. I would like to highlight 5 key strategic initiatives taken by the company during the year. We have acquired Ace Money to capitalize on the strong growth in the digital payments and complement our cash management business. We have forayed into DPJ segment, that is diamond, bullion and jewelry segment, as a large adjacent business opportunity. We have increased focus on our direct clients business and strengthened the team and outreach into these clients largely serviced by the nationalized banking sector. We had acquired 220 cash vans and increased our focus on cash van operations segment. And lastly, we had launched Radiant Insta Credit or RIC, leaning heavily on our new acquisition in digital payments, which has enabled us to target a much wider small outlet market. I'm happy to inform that each of these initiatives has matured well and we are poised for a healthy growth of 18% plus in revenues for the current financial year, in line with our long-term revenue guidance. At the same time, the core business faced certain headwinds last year, specifically petroleum segment and e-com logistics segment witnessed drop in volumes and points, besides pricing pressure from a few clients. Your company has taken several corrective actions, including strident cost control measures, and we are confident of restoring our growth and profitability to our historical trend levels in the current financial year. I am happy to announce that in keeping with our standard practice of declaring regular dividends, our board has proposed to declare a dividend of 250% of the face value of equity shares. I would like to re-emphasize that in keeping with our standard practice of declaring regular dividends, our board has proposed to declare a dividend of 250% of the face value of equity shares. Our widest network in the country, covering 14,370 PIN codes, our strong risk management practices as reflected in lowest cash losses in the industry, and a strong technological backbone covering every aspect of our operations remains our core strength. Our performance for this quarter and year ended March 31, 2024 was a mixed bag. We have done well in cash van operations with 53% revenue growth, direct clients going up to 50% revenue growth, cash burial 14% growth, but have had muted growth in the core cash pickup and delivery segment. Cash handle for the year was rupees 1.67 trillion, representing 6.2% growth over the previous year. As a company, we continue to maintain the highest return on capital and return on equity in the industry. Our fintech acquisition in the last year, Ace Money, has done very well, and I'm happy to inform you that we have already achieved operational break-even in this business. This business is poised for excellent growth in the current year. Mr. Alexander David will speak more about it shortly. The diamond bullion and jewelry segment is undergoing a period of strong consolidation after rapid expansion of its infrastructure and network last year. The key focus of this business is achieving profitable growth, and we expect this business to reach break-even within the next 2 quarters. Both Ace Money and DBJ will contribute positively to the EBITDA of the company in the current year, which should help restore the company to its previously healthy profitability levels. Our priorities are to restore the revenue growth to the historical trend levels in the current year through addition of direct clients and offering a wider range of technological solutions to our clients. The potential for growth is enormous, as the doorstep banking services or retail cash management is still in the nascent stages in India. We are excited about the journey ahead. As always, we remain committed to providing transparent updates on our progress and answering any questions that you may have. I will now request Mr. Alexander David to speak about the progress achieved in Radiant Ace Money. It's over to you.
Thank you, sir. Good morning, everyone. I'm happy to present the update on Radiant Ace Money, our recent foray into the fintech industry. Since acquisition in November 2023, Radiant Ace Money has started growing at a rapid pace with a clear target towards increasing its digital footprint of POS machines across the hinterland and offering a wide range of transactions and services to these retail outlets that were hitherto not part of the fast-growing digital economy of India. Over 50% of India's 20 million retail outlets do not have any form of digital payment acceptance as yet, which provides ample opportunities for growth for Radiant. The strong support from the government to bring every individual and every commercial establishment onto the digital banking infrastructure augurs well for our ambitious growth plans. The synergy benefits between Radiant and Ace Money have started to flow as envisaged during our acquisition. Radiant's 7,000 plus strong feet on street of cash executors are at the forefront of rolling out the Radiant Ace Money POS machines in remote areas, as far as in the Tier 3 locations in Northeast and Jammu and Kashmir. Ace Money's rich experience in fintech also came in handy in our rapid rollout of RIC by the parent company to tap a much wider market for offering its retail cash management solutions. In terms of financial performance, Radiant Ace Money clocked rupees 35 million in revenues for FY24, representing 110% growth over the previous year and has improved upon its EBITDA level losses. I'm happy to inform that we have currently reached operational break-even in this business, and financial year 25 appears to be a very promising year for both revenue growth and profitability. I would now request Mr. Muthuraman, our Head of Strategy, to present our operational performance.
Thanks, Alex. Good morning, everyone. Thanks for joining us on this investor call today. I'll present the company's key performance indicators for the year ended March 31, 2024. During the year FY24, we handled 1.67 trillion of cash, representing 6.2% growth over the previous year. During this year, we added 64 new clients, 104 new end customers, and 6,514 new retail touchpoints. Today, we service close to 70,000 touchpoints, covering 14,300 plus PIN codes across 8,000 plus locations. And we continue to have the widest network in the industry. In terms of sectoral performance, we witnessed strong growth in the petroleum sector, which clocked 54% growth over previous year, largely a catch-up growth. Organized retail, which grew at 27%, and BFSI segment, which reported 16% growth. As mentioned in our earlier earnings calls, our overall growth was muted due to subpar growth in the e-com logistics sector. Our recent launch of RIC is being reviewed very well in the market and will help improve the subpar performance in this segment. In terms of business verticals, we witnessed healthy growth in cash run operations, a 53% growth, albeit on a small base, and network cash management, which grew at 14%. However, the growth was muted in the core business of cash pickup and delivery at 2.2% because of the degrowth in e-com logistics segment and pricing pressure from a few clients. The mitigating measures taken to address this include stronger focus on direct clients from the untapped nationalized banking sector, which grew at 97% this year, and the launch of RIC, which opens up a much larger market for cash management services. I'll now hand over the call to our CFO, Mr. Venkatraman, to present our financial performance.
Thank you, Muthuraman. Good morning, everybody. Coming to the financial performance, the total standalone revenues for FY24 were rupees 3.9 billion, representing a growth of 9.2% over the previous year. EBITDA margins for the year stood at 17.7%. This was an impact of a conscious decision of diversification and growth for just this financial year. I would like to repeat that this was an effect of a conscious decision of diversification and growth for just this financial year. The EBITDA margins are affected mainly because of the losses incurred in the DBJ business, which we entered in July 2023. The initial period of this business was focused on building the requisite infrastructure, including branch network, manpower, armored vehicles, and its crew. This business has scaled up well and has established its credentials among its key customers. The focus has now moved to achieving profitable growth, and the management is confident of achieving break-even and have positive contribution from this segment in the current financial year. The other key reason for the drop in margins is the cash van operation segment. Though the segment has grown at a healthy pace of 53%, the profitability in this segment is still not reflected fully, as we are still in the deployment phase of the 220 vehicles acquired by the company during the year. As can be observed, expenses in DBJ business and cash van operations are in the nature of investments and prerequisite for strong future growth of the company. We expect margins to improve further in the coming quarters because of the measures taken by the company. The return on capital employed for the year was 22%. Investment in cash vans to the tune of rupees 240 million during the year, and the drop in EBITDA margins, as discussed earlier, have contributed to a reduction in ROCE. Return on equity for this year was 17.9%. I would like to highlight that the ROCE and ROE for Radian continues to be the highest in the industry because of our strong and clean balance sheet, high fixed assets turnover ratio, and strong working capital management. I would like to add that our cash flow from operations is 46 crores for the current year, more than the PAT for the current year. This indicates a very level of high efficiency in working capital management. In conclusion, the year has been one of expansion, diversification, and investment in complementary areas with significant growth opportunities. With new initiatives, as highlighted by CMD in his opening remarks, we are building new long-term levers for growth with a more diversified revenue profile and robust profitability. I now hand over the floor to Sarvesh for question and answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask the question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for taking my question and congratulations on good numbers on retail touch points which we have increased in the last quarter. So, sir, my first question is related to the retail touch points only. So, in Q3 we had a tepid growth, but in Q4, so is it something seasonal or have we done something different in Q4, or how do we look at this number in the coming year directionally?
Yeah, thanks, Ankit. We have been consciously looking at opportunities for entering newer markets. As I had just mentioned, our direct revenues have grown by almost 97%. All of these have added new points. And as CMD mentioned, the market opportunity is huge and the level of penetration of these services is very small. So we are confident of adding gross additions of about 1,000 points every month in the coming year as well.
Okay, got it. Sir, in the presentation and also in the opening commentary, we mentioned about the two areas where we had some problems. One was the e-com logistics, which we, I think, alluded in the last call as well. But I think this is for the first time we have spoken about petroleum segment. Can you give more color into what happened in the petroleum segment?
Yeah. So this was a one-time sharp reduction in volume that happened in Q1, later half of Q1 and second half of Q2. So which affected, because of the Ukraine war, the domestic refiners diverted their refining capacity towards exports rather than domestic markets. So that affected the overall volume sharply. But we have subsequently, since Q3 onwards, we have been reporting healthy growth in this segment. But still, at overall, for the full year, our revenues are still lower than what it was in FY22. And we are almost there, almost 80-85% catch-up has happened, and the segment continues to grow well.
Thank you, sir. And sir, regarding the Ace Money acquisition, and as we have mentioned in the opening remarks that the synergy is taking place and there was some really good growth in the current year, in the last year, in FY24. But in terms of numbers, I don't need an exact guidance, but in terms of numbers, how do we see this business contributing in FY25 and FY26? In percentage terms, if you can mention of total turnover, where it would be.
Yeah, I'll take that on. Thank you for the question. Ace Money, we've had 110% growth over the previous year. And in our previous earnings calls, we had mentioned that we are looking to distribute over 1 lakh POS machines over the next 2 years. And we are well on the way of achieving that. So that should contribute to a steep growth in revenue in the coming financial year. As we already mentioned, we have already broken even operationally, and profitability also should be in line with that. So we can't put a number on percentage, but that should be, we are definitely going to be seeing a steep growth in revenue over the coming year.
Is it okay to assume around 20% of the total revenue would be contributed by Ace Money in the next 2 years?
No, I think it will be a smaller number than that, because the core business also we expect to grow at a healthy pace.
Okay.
It will be 10% program.
And sir, one last question related to the direct clients initiative which we have taken up consciously in the last year. If you can throw more color as to how we are progressing and what are our plans for
I'll step in on this. Direct clients we've been focusing on, you see, 67% of the clients are covered by the nationalized bank. and the penetration as far as retail cash management in this segment is very less. And there are quite a few clients who are being serviced by the sector. So therefore, we are focusing on these clients who are being taken care of by the nationalized banking sector, and we are bringing them on board now that we are a listed entity as direct clients. So that's an area of focus for us.
Any particular customer segment or industry segment we are focusing on?
This is highlighted by a head of strategy.
Hello?
Yes, please.
So any particular industry segment we are focusing more on when we are looking at direct line? Any few industries we are focusing more on?
See, the large potential do exist in jewelry, petroleum, healthcare sector. But this is, again, as you can see in our own revenue profile, everywhere, wherever there is a daily cash collection, it's a potential market. So the market is fairly large, and we are not restricting to targeting any specific clients. We are going all out on this.
And one last question before I join in the queue. For expanding this direct client business, do we need to or do we plan to onboard more employee strength, or do you think that the current employee strength is good enough to handle this work?
No, we are building a sales organization for this purpose. Yes.
Okay. Thank you so much and all the best. I'll come back in this.
The next question is from Divanshu Mahavar from Dalal and Broacha Stock Broking Private Limited.
Thank you for the opportunity, sir. Just wanted to know about the retail opportunity. So in the Frost and Sullivan survey, if you look at India has total 40 lakhs retail touch points, organized plus unorganized, and out of 6 lakhs are organized. And out of 6 lakh, 1,50,000 are using outsourcing service. So what kind of growth you are seeing that the 1,50,000 will grow from here, and what kind of market share you are looking for there that you want to capture from it?
The numbers you have indicated are quite conservative. I mean, we are not just looking at only organized retail. We are looking at every form of retail outlets, including restaurants and education institutions, hospitals, pharmacies, whole host of them. As in our own estimate, based on third-party research, close to 20 million mom and pop stores, to roadside vendors, to large organized retail outlets, 20 million are there. 25% of that would be eligible to use a service of this nature is our estimate, market size estimate, which is like 5 million. But all the players put together hardly handle less than 200,000 outlets. So the growth potential is huge. Historically, we have grown at 18% plus CAGR, and we don't see any problem in continuing to grow that number.
Okay, thank you, sir.
The next question is from Vikas Kasturi from Focus Capital.
Hello, am I audible?
Yes.
Yeah. Hello, Muthu sir. Hello, Colonel. So I had a few questions. So one is, could you please provide some description on the cash logistics that you do via two-wheelers? For example, number of two-wheelers that you deploy and the percentage of cash volume that is transported, and where do you use two-wheelers and where do you use the van? Some idea on this, please.
See, there's a phased rollout by RBI on as directed by RBI to the banks on the movement of cash only through van. And banks adhere to that, and in turn, as service providers, we adhere to this plan. So as of now, it's about 120 cities where RBI has rolled it out, which covers almost like 80-85% plus of the cash volumes. So even before RBI plans, almost more than 85% of our cash by volume are transported by vans. So only in Tier 3 plus remote locations where the volumes are small, as we transport as per the Ministry of Home Affairs guidelines.
Okay. I don't know what Muthu has said. Maybe even in very densely congested areas where taking a van may be difficult, we could probably use the hub and spoke model to pick up some cash. But as he mentioned that even before implementation of this, we are about 84-85% of the total volume of cash is moved by a cash van.
Thank you, sir. Next question is, what percentage of your 840 vans are in the cash in transit business versus the cash pickup business, sir?
Yeah, about our cash van operations today is roughly about 150 vans. Okay.
And sir, could you also just provide some description of the DBJ business, as in would it be air logistics or air plus ground logistics? Some idea of like where you're moving the jewelry from where to where kind of a thing, sir. Could you just help me understand that?
Sure. So that business has both.
Sorry, sir. Sorry to interrupt. And can you transport cash and DBJ at the same time in the same van? That also, sir. Yeah.
At this point of time, we have kept DBJ and retail cash management as independent business verticals. We do have some synergies in terms of branch operations, but otherwise the vehicle infrastructure, the transport infrastructure is independent between these two. Over a period, we can look at synergies, but being an early new entrant into this segment, dedicated focus is required. So that's the implementation at this point of time. This segment involves both surface transport as well as air transport. Roughly half of our business is from surface and the other half is from air cargo. And so the movement is on various legs. One is from the import ports to the manufacturing units. Second is from manufacturing units to hub like Zaveri Bazaar, Bombay. The third leg will be from hubs to actually the jewelry retail outlets spread across the country. So all three legs are handled. Roughly about maybe up to 250 kilometer radius is by surface transport, and beyond that is through air cargo.
Got it, sir. Thank you. And one last question, sir, to our CFO. Sir, could you just throw more light on what constitutes these other expenses?
Yes, other expenses mainly consist of service charges for the cash executives, the van vehicle expenses, the driver and gunman cost, and power and fuel, and all other expenses like all the major items. Bank charges. Bank charges also forms a major component of that. These are 5-6 major categories consisting of other expenses.
Okay. Thank you, sir. I'll come back in the queue.
The next question is from Aditya Sen from Robo Capital.
Hi, thank you for the opportunity. Sir, we have fallen down from our peak EBITDA margin significantly, and the reasons we have already stated. So I just wanted to know in how many quarters or in how many years will we inch up towards the previous highs of 28 to 30% EBITDA range?
Yeah. We expect that in the current year, we should be able to, in the third and fourth quarter of this current year, we should be able to revert back to historical levels.
Of 28-30%?
Historical levels, I think FY2023-24, 25%. Yeah, those numbers.
All right, sir. Thank you. Bye.
The next question is from Arvindar from Sundaram Alternates.
Hello, sir. Thank you so much for the opportunity. Obviously, you mentioned about the investments we have made in DPJ business and the employees to acquire the direct sales and multiple investments we have made in FY24. How to visualize the investments or expenses in FY25? Like what could be the run rate of employee or other expenses in FY25?
See, this year the employee cost was higher because of the reasons stated above. Because of new additions in the DBJ business, and also we have made some addition to employees to cater to the increased business in future. But in FY25, we expect the employee cost to come back to the 22-23 levels.
Sorry, that you mean in absolute terms or growth wise?
No, as a percentage of sales.
Okay, and I had another question, within the breakup of the businesses we do put in the presentation. I can see that except BFSI and organized retail, all other businesses have reported negative growth in year-on-year terms. I'm just trying to understand what makes us believe that the growth will come back. How are we hoping to get which segment will come back? Even the e-commerce segment growth has been weak. Year-on-year terms, it has been negative 3.5%.
No. E-commerce segment has grown. There is negative growth only in e-com logistics and near flat growth in railways. All other segments have grown at a positive rate.
Okay, because you give percentage numbers, I was back calculating it. I'm seeing 136, 14 crores and 13 crores in FY20.
So for example, railways was 10.6 crores in FY22, about 14.5 crores in both FY23 and 24. Organized retail, 32 crores in FY22, moved to 54 crores and further to
Sir, obviously, e-commerce, on year-on-year basis, on the full year, it has grown. I'm not denying that. I'm asking about, fourth quarter 2024 versus fourth quarter 2023.
Yes, we had indicated this e-commerce, particularly our business is seasonal. Q3 is the best quarter, followed by Q4, followed by Q2.
No, sir, even on year-on-year terms, I understand Q3 to Q4, there will be decline.
There is no decline in e-commerce business year-on-year from FY22 to 23 or 23 to 24.
Okay.
E-com logistics, yes, there's a decline, but not in e-commerce, not in petroleum, not in BFSI, not in organized retail.
The next question is from Disha Gandhi from Motilal Oswal. Please go ahead.
Hi, am I audible?
Yes, please.
Yes, thank you for taking the question. I wanted to understand a little bit more about the RIC business and how it has progressed so far and what are your plans in the future?
I'll take it on. The RIC business, essentially, one of the reasons why we acquired Ace Money was this. We wanted to also get into the digital payment ecosystem and align it with cash logistics. So with that, we are now able to service a large number of clientele in the extreme hinterland. And the client profile has completely changed as a consequence in terms of business correspondents, small-time merchants, whom we are able to service using our digital solutions that's available from the acquisition.
RIC is also helping us in regaining our lost market share in the e-com logistics.
We are focusing on e-com logistics, so that is also being reinforced by these new systems that we've got.
Sure. And in terms of the plans going forward, is the same strategy that we'll continue, or do we see more traction coming in from the hinterland? Or is there a similar service application need in the other markets where you are present currently?
as of now, we are exploring what all opportunities are there and how to take this forward. But it's an exciting new area, and we are looking at it very closely. It's going to have a very substantial contribution to our revenue performance in the coming years.
Okay, thank you.
Our next question is from Prashant Pandalatil from Navix Investment. Please go ahead.
Hi, am I audible?
Yes, Prashant.
Hi, everyone. Thanks for the opportunity to ask a question. My question is around the segments. So, in the initial presentation, it's clear that the trend is the segment revenue is shifting from cash pickup delivery to the other segments like network cash management, cash processing, etc. So, how would this have an impact on how is the margin profiles of the other segments compared to the cash pickup delivery, and how do we think the profitability pathway would be once the cash pickup delivery goes down and the other segments pick up?
Okay. See, our cash pickup and delivery is the base on top of which network cash management, cash processing. Yes, it has grown slower, and hence the composition of the segment-wise revenues look a bit skewed at this point in time. As I said, in any of these are the strategic initiatives that we are looking on direct sales, on RIC, etc., will help grow our core business of cash pickup and delivery, and on top of it, the other businesses will continue to grow. So we cannot, as in the sense that is the cash processing or network cash management cannot operate on a standalone basis without the core business of cash pickup and delivery. So there is no point in, as in the sense, we cannot portion costs to give margins individually like that. But yes, the low growth in cash pickup and delivery is one of the reasons why our margins have come down. As I said, that is particularly so from the e-commerce logistics segment.
Got it. Okay, thank you.
The next question is from Abhishek Chawla, an individual investor. Please proceed.
Hello, thank you for the opportunity. After the present investor deck, page number 23, the client base has increased significantly. At the end of FY2024, you have 153 clients. So could you just explain who these clientele are? Because let's say if you add someone for Insta Credit, is that counted as a client?
No. This is if it is a large B2B business, we will be adding that under the client count. This 153 client count doesn't include any Insta Credit clients.
Okay. Does this include the...
That will get added in the point. That will get added in the point.
Okay. The Insta Credit is added in the point. And the DVJ business, is it added in the 153, the GLLPR?
No.
Okay. And with regards to the touch points, they have increased and so has the PIN code. So is it fair to assume that the new touch points are in the new PIN code, and because of that the root density is still low?
I'm sorry, we couldn't hear your question. Can you just repeat and speak a bit away from the mic? Not able to hear properly.
Okay. The touch points have increased and so have the PIN codes we are servicing. So is it fair to assume that the new touch points are in the new geographical regions and the root density is yet to pick up?
Yes. Yes, the number of as you can see, number of locations, number of PIN codes both have increased substantially along with the number of points, which means we are covering more and more geographic areas. And that has been our core strength. Once we establish a presence in those locations, additional points will help in improving root density and thereby the profitability.
Got it.
I'd like to add on to what the head of strategy said. Earlier we used to ignore locations where there's just one point coming up. That we have stopped doing, and that our focus during the last year has been to build infrastructure, and even if there's a single point, we are moving to those locations, and that's how this location strength has grown up by almost 3,000 new locations. We are expecting many more points coming up in these locations, which will further enhance our revenue profile in the years ahead. That was again a conscious decision that we took last year.
Thank you. The next question is from Ankit Kanodia from Smart Sync Services. Please go ahead.
Thank you for allowing a follow-up, sir. Sir, my next question is related to the strong balance sheet and cash positions we have. So as you have mentioned that we have been building, this was a year for consolidation and transformation, and we still have a strong balance sheet and high cash. And the stock is probably available at a very reasonable price right now. So rather than dividend, are we also thinking of a buyback at this juncture?
No.
To give some confidence to the investor community.
At this point in time, we are not thinking of a buyback of shares.
Any reason for the same, sir, if you could clarify?
Yeah, I'll just add. As Colonel mentioned, we have, as in the sense, we have entered into 5 new strategic initiatives. Each of these will grow at a healthy pace. Yes, the balance sheet has maintained fairly strong in FY24, but we are reasonably sure, as in we will need some more additional working capital and some minimal capex to meet the large growth aspirations that we have. So we will be conserving cash to meet those aspirations. And direct clients have its own issue of, as an instance, we need to provide certain bank guarantees. So a strong balance sheet is important for us to do that. So buyback will be a very wrong signal. As in we are aspiring for a high growth. So we will need all the cash that we generate from operations for funding our future growth plans.
No, sir, but my point was the amount which we are declaring as dividend can go as buyback. I'm not asking for a separate allocation for buyback. The same amount which is going for dividend, if we allocate it for buyback, don't you think that will be it will be more tax effective as well, and it will send a strong positive signal to the investing community?
No, Ankit, as in we have indicated the thing as in historical payout ratio of between 40 to 60%. So we will maintain that and we'll hope to continue to do so in future as well.
It's a good point that you brought up, but let me say that in the entire environment, this is the first time we have heard anyone mentioning this. Otherwise, the strong dividend profile that we have has always been applauded.
Sure, sir. Understand. Thank you. Thank you and all the best.
Ladies and gentlemen, a reminder, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next call is from Vikas Kasturi from Focus Capital. Please go ahead.
Hello, sir. Sir, I had a question on slide number 23, where you have given request pickup points. So are these same as your direct clients, sir?
No. We have provided in detail this thing in our DRHP. This is a steady, constant KPI that we have been disclosing. The deep pickup points are the points where we visit every day. Request pickup points are the points that we visit only on request.
Okay. Got it, sir. Sir, would it be possible for you to mention the direct pickup points here, sir, in this slide going forward?
No, the direct revenues we are disclosing, as in individually direct pickup points would be competitive information that we would not want to share.
All right, sir. Sir, I had one suggestion. Your previous answer to Ankit, you had mentioned that you are, building a sales organization to address the direct clients, right? And sir, you might also want to consider employing a business service company, and you could pay them for every client who signs up. So that way you don't have to employ people on your own, and you just pay for outcomes. So is that something that is allowed by RBI and so on, sir?
Yes, of course. It's a good point that you brought out, and we are exploring these new options also. This kind of marketing organizations can help us out. It's being actively explored.
All right, sir. Thank you, sir, and wish you all the best.
Thank you very much.
The next question is from Asim from DAM Capital. Please proceed.
Hi, just two bookkeeping questions. First, on your revenue breakup by industries that you give in your presentation, just a clarification, this percentage, is this out of total revenue that you report, or is it just the revenue of your cash pickup and delivery business?
It's only not cash pickup and delivery. It's total for retail cash management business.
So that includes that network cash management, cash van operations as well, or you're just taking cash pickup and... Okay, so it's consolidated revenue, the proper total revenue, right?
See, no. Our revenues have 3 or 4 components. The retail cash management, and then we have the DBJ, and then we have, in a consolidated level, we have for the ACE money. So this segment, industry segmentation, it covers only the retail cash management business. So the sub-segments of that is given on the same slide on the left-hand side. All of these are covered. Cash pickup and delivery, network cash management, cash processing, cash run operation, and others.
Then, how much is the non-retail cash management revenue as a percentage of total right now?
So as you mentioned, RVL is roughly about, for last year they made about 2.3 crores revenue.
Okay.
In the standalone numbers. The consolidated numbers, we have additional 1.5 crores or so of SAT. That is the 4-month numbers that got consolidated.
Correct. Got it. And second, what was the bank charges number for network cash management business in Q4 and for FY24 as a whole?
The total bank charges will be roughly around 20 crores for the year.
Okay, and for the quarter?
Yeah, proportionately, about 4.5 crores, 4.2
crores for Q4.
4.3, I think. 4.3.
Okay, great. Thank you for answering my question.
The next question is from the line of Abhishek Chawla, an individual investor. Please proceed.
Sorry, my line got disconnected last week. So I had a question. What are the regulatory limitations on Insta Credit? What do I mean like that? RBI and all income tax department, they are very stringent on who handles the cash. So I'm just trying to understand, is there a monetary limit, like the maximum you can do for Insta Credit is 2 lakh or something like this? So what are the regulatory limitations on that?
Some of this is competitive information, but yes, we do have a limit. We are laid on a limit, and we function within the realm of that limit.
Okay, got it. And lastly, the initiative in technology deployment for your mobile apps which you are doing, can we expect your billing cycle to shorten? As you have previously mentioned, after the month end, there is a 10 to 15 day reconciliation period. So can we expect that period to come down to 3-4 days with the deployment of more technology?
No, because the system works like this. We have to give the details to bank. The banks have to approve the billing amount only. So that process takes about 10 to 15 days time. So we don't expect the billing cycle to come down in the near future.
Okay, so how many days does it take for Radiant to give the detail to bank? Like, is it handed over on the 1st of the next month?
So it happens throughout the month. First 15 days it happens within the 25th, and for the second fortnight it happens before the 5th of the month, so that we close the billing by 8th of the next month.
Got it. So mostly bank takes time in reconciliation and then they have their credit cycle, credit period.
That's right.
Okay. Thank you. That's it from us.
Yes. The next question is from the line of Arvind from Sundaram Alternatives.
Thank you again so much for the opportunity. One of the competitors who was doing this DBJ business has 300, 400, 320 crore kind of a revenue. What I'm trying to understand is what kind of potential are we seeing in DBJ business, and within our core business segments. Which segment do we expect to grow really faster in next 2 years?
Our own estimate is that the DBJ market size is roughly about 1,000 crores, both organized and unorganized existing players put together. So we are a very small player, and we have fairly large opportunity to grow that. And in terms of growth, organized retail continues to expect the significant organic growth that we are expecting, followed by BFSI, followed by e-commerce. We are expecting that the e-commerce logistics will report a catch-up growth this year. And railways will continue to remain flat. Railways itself had grown at about 5-6%, so we will continue to have that unless we add more regions. And the petroleum sector has some more opportunity to do catch-up growth, and then that will be a steady-state growth there.
Sure, sir. I just one point, one query, in first half of FY24, we did rationalize some touch points, and we again started adding. How are we going about it, in terms of, understanding, okay, this point is still, will be profitable. What were the learnings, if you can share some, how have we changed the strategy in terms of point addition?
We, in a sense, we set certain minimum threshold volumes and revenues for each point, below which, unless it is part of a larger thing, particularly it's done point by point, route by route, etc. So I don't want to disclose too much competitive information for us as well.
Sure.
But we, as you can see, we've started adding healthy numbers. Relatively healthy numbers, still not back to the previous levels, but 2,300 plus, almost 700 points plus per month we have added in this quarter. And we expect we'll hit 1,000 points plus in the current year.
Yes, the next question is from the line of Ankit Kanodia from Smart Think Services. Proceed.
Thank you, sir, for taking the call up again. So we have basically two large players in the industry, and as we have mentioned earlier, and it is quite evident that the industry is going through consolidation. But both the players, we and our other competitors, listed competitors, we both have completely different strengths. As in, we are going deeper into our main core business, whereas our competitor is going completely in a different direction in a way that they are trying to cover the entire value chain of the cash management. So internally, do we discuss these kind of opportunities, whether we want to go ahead or change our plans, or we are very clear as to we want to be a focused player and focus only on the retail cash management part? Any thoughts on that?
We are very clear we don't want to get into the ATM segment at all. There's a huge growth opportunity still in retail cash management, and each of these are different markets that will continue to feed us for a long time.
But when we see the managed services business growth, it is growing pretty fast. I'm not just talking about the ATM business, but about the managed services business. So and the other automation business which is available. apart with that. So don't we find that attractive enough for us to have a look at?
In this, there are already large. You see, managed services is based on the number of ATMs that are serviced by the concerned MSP. And that segment is already fairly consolidated as of now. And unless you have the economies of scale to have ventured into a new segment, initially it will be very capital intensive, and strategically also it's not a good decision to take. And therefore we stay focused on the areas that are proving to be more lucrative and more rational and pragmatic for us at this point of time.
Thank you so much, sir. That was very helpful, and all the best for the future.
Thank you so much.
As there are no further questions, I would now like to hand over the conference to Mr. Sarvesh Mehta for the closing comments.
To Colonel for his concluding remarks.
Thank you, Ralph. And thank you, Colonel Sir and the team for giving Antique Stock Broking this opportunity to now hand over the call.
Thank you very much, Sarvesh. Excellent questions. I must compliment everyone. It's been a very interesting session for us. I'm personally very positive about our future growth prospects. And the 5 key strategic initiatives taken during the last year have bearing fruit. As investors, you can be assured that we are well positioned to tap the wide and fast-growing retail market opportunity across India. Our retail cash management services are still largely untapped, with less than 3% penetration levels at this point. Our approach aligns perfectly with the market dynamics, enabling us to tap into the vast unserved market and drive sustained growth. I want to express my gratitude for your continued support and faith in Radiant. We are confident that our focused approach and strong performance will yield promising results for all stakeholders in the coming years. Thank you for your time and your continuing interest in your company. Thank you very much.
Thank you. On behalf of Antique Stock Broking, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.